Hi everyone, welcome to yet another video in the series of learning financial accounting. I hope that you're liking this blended form of learning where some theoretical concepts are getting recorded in videos like these and the real magic happens in the class, the live classes. So in this video, I'm going to talk about something, which is a bit boring. Yeah, we call it with the name accounting framework. Well, honestly, the name doesn't tell you much. Looks, to be bigger than what the actual concept is. But I want you to again request to take things very commonsensically, and following the same spirit, we are going to use some household examples, the examples from your common life, so that you can understand the business accounting a bit better, right? So I'm going to share off my screen, and now I hope you can see it. Accounting framework, but the word framework pretty much is a sum total of overall system in every country, and more or less it is similar. I'll highlight where the systems are a bit different, but more or less each country has a similar sort of an infrastructure. It's an infrastructure made up of rules, made up of guidance notes, made up of something called as accounting standards, and even granular, made up of basic definitions as to what is the thing or when do you call something an asset. Okay. I'm also mindful of the fact that by now basic meanings of assets, liability, equity, income, and expense. So allow me to use them relatively more freely. In the first two sessions, I was a bit conscious of using them. This really remains my anchor slide where every time I shift my focus so that, it is easier to steer your thought, in the entire learning exercise. So I am going to speak about initially here, which is a step, like we had said, is done by, a chartered accountant or an accountant. And again, a step which is done by CA. So this really, this session and the class that is going to follow is really going to be a pain point to a lot of non-commerce students, because these are the two basic steps which are done by hardcore commerce people. And like I initially said, that you would not face a lot of problem here through your corporate finance learnings, and you would also not face a lot of problem here because, again, as an MBA or as a business student, it's easier to analysis comes naturally, at least compared to 2 and 3. So anyway, let's keep the spirits high and focus on something called as accounting, and focus on something called as financial reporting. I'm mindful that that this is an input and this is an output of an accounting information of a business transaction. And I'm also mindful of the fact that you have already summarized a particular case into meaningful output reports. So from one, you have already done step 3. It's just that now I want to bring in step number 2. Put very simply, okay, this really is the holy grail of the problem. So accounts, okay, in general lingo, you would have heard about account. In general lingo, you would have spoken about accounts. But what really is accounts? Accounts, to my mind, simply is record. Period. That's it. Record. Of what? Now that qualifies a household or a personal account from a business account or a financial account. So let me take some household examples. Let's say many of you, and by now in the current century, in the current year, everyone has a credit card. So your credit card statement, credit card is not an account, but your credit card statement is an account. Many of you have PhonePe, Paytm, different mobile wallets, and these wallets, out of reporting practice, sends you a monthly report of your usage. So that monthly report is actually a summation of your different transactions. That's nothing but your account. So account, to my mind, is any record, and of course it will have some historical information. You can't foresee that, so it will never be a futuristic information. So it's very, very historical looking thing. All right. Now, the process of accounting, which is going to follow, largely has 3 different steps. And therefore, we divide the bigger word accounts into 3, again, micro steps. Step number 1, 2, and 3. And you don't have to really worry about understanding them right now. It's just a precursor. You and I will actually, in the class that we follow, will do each of these micro steps. We are going to make a journal, we are going to make a general ledger, and we are also going to make a trial balance. So therefore, don't worry about it. But once you enter that class, I just want you to be mindful of the fact that you have been exposed to few basics, which we are going to do right now. So what is a journal? So journal, just remember, it's a chronological recording of business transactions without applying any mind whatsoever. So business, let's talk in context of business. So business has taken a loan from a bank. That's a transaction you recorded. Using that loan, business buys some raw material. You record that transaction. So it's a chronological recording. Business made some sale. Business out of that proceeds paid some salary. Business paid some rent. So all of these transactions, without applying any mind whatsoever, it's a chronological dump of transactions. A lot of transactions gets to be recorded here, and it's basically a data dump. The point is, by the end of the year, a reasonable sized company would have at least 1 million transactions. And if you hand over those million transactions to any stakeholder, they will not be able to make any meaning out of that. That means more is required. And that's where step number B, general ledger, comes into picture. What they do is, so you would imagine that sales, the exercise of selling the product or service, would have happened all 365 days of a year. It's not that sales happen only in December and not happen in February. So so if someone at the end of the year asks how much is the total value of sales, do you expect the accountant to look at all 365 days ka data dump, which is called as the journal, to arrive and recalculate the figure? It's very difficult and boring. So what the accountant additionally does after making this chronological order is classification of similar items on one single page. That one single page is called as ledger. And why go far? Each of your B schools have a ledger in your name because there are multiple transactions that each of your B school does with you. Taking first installment, or forget about installment, admission form, GDPI, then selection, then first installment, then issue of email ID, then library card, then books, then etc. So do you see that single subject matter entity, which is you, are getting exposed to multiple transactions in this case? So that's where the general ledger comes into it. So what they do is typically they look at the all the transactions related to one student on one single page, just for the point of classification, for quick retrieval. That's the USP of a ledger, quick retrieval, so that you can easily create subtotals very, very quickly. And then finally, there's a bit of maths involved. And therefore, finally, after doing all that classification, they just want to check the mathematical accuracy, for which trial balance comes to the picture. So, in today's world, as everything is computerized, network, etc., the role of trial balance has reduced quite significantly. Today, we have ERPs, enterprise resource planning softwares, where a business transaction gets automatically recorded into the books of account. There is no scope for any mathematical problem. Mathematical totaling errors, decimal errors, etc., are things of past. When our grandparents, or let's say even our parents, were accountants, they used to find the totaling errors somewhere. But these days in computer times, you would not. So therefore, importance of trial balance is going out of the way a little bit. Okay, I want to come back to something called as accounting. Accounting is nothing but the process of making accounts. I would like to put it as simple as that. So it's an art of recording, where in a journal, then classifying, where in a ledger, and then summarizing how and where in a trial balance. Significant transactions, which are obviously, now that everything has to be expressed in terms of money. We call it money measurement concept. Any transaction or event, blah blah blah, in financial character. So don't worry about the theoretical definition. So to my mind, accounting is the act or the process of making accounts. So if you understand accounts well, accounting is just a process. Brings me to another very important point, and again a little confusing point, called as accountancy. So you see that the names are very, very phonetically same: accounting, accountancy. But let me tell you, accounting is a bigger umbrella. Accountancy is one small tool in it. So I want you to look at that as a tool to aid in the process efficiency. What happens is, there must be crores of accountants in the world, and every individual has their own individual whims and fancy, beck and call. So you can't really allow everyone to record transactions as what they think is right. So you need to have some standardizations across. So the key word again, like I'm saying, is the word standardization. So what happens really is, uh, all of you, while filling up the form of your B schools, I am sure would have filled up exactly the same form. It's not possible that person A's form is in pink color, person B's is in yellow color, D is blue, someone is purple. So you see that whenever the scale is a paradigm reality, whenever you're dealing with volumes, you tend to standardize things to gain some efficiency. That's exactly what accounting framework also does. So imagine person A sells goods to person B. Okay, in this case, there has to be some basic rules in place to guide person A and person B as to what is the cutoff point where the sale should be recorded. Is it when A receives the order? Is it when A dispatches the order? Is it when B receives the order? Is it when B makes payment to the order? You see, there are four different temporal points. At each one of it, there could be a confusion as to, is this is the point of sale? Therefore, you need a bit of rules, guidance notes, accounting standards, different names in different countries. You understand it as rules, just so that two companies, when you compare them at your stage 4 of your anchor slide, remember, ultimately the objective for a B school student is to be able to make comparison. And that is what accountant is also mindful of, the fact that ultimately some stakeholder will take my statement for analysis. So the point is, whenever the two companies are compared, it's not that the entire effort should go into sanitizing and bringing them on the same page. So accountants are supposed to not form, but follow some standard basic rule. There is a bit of flexibility. I'm making a point that there is a bit of flexibility, and I'm going to give you a word: choice of accounting policies. Accounting policy is how you should record a particular statement. Okay, that's broadly the point. How, the thought process, the method of thinking, that's accounting policy. Big deal. I don't want you to bore you right now, but it means SLM versus WDV. It means LIFO versus FIFO. These are the names that I will throw you once you become relatively more mature. But the short point is that accountancy is a sum total of different choices of accounting policy that each country has. It has techniques, it has rules, just to ensure standardization. Quick question: who make those rules? There are some technical bodies, one in each country, designated to make rules. But that technical body is actually brilliant, brilliant, mindful people, but they don't have a lot of enforcement power. So for enforcement, you need another agency pretty much independent of the technical, which is a big daddy, like a police wala with a danda in his hand, as a regulatory body. And the regulatory body in Indian context is, let's say, for listed companies, is Securities and Exchange Board of India. In context of rule making, it's Institute of Chartered Accountants of India. In case of UK, it is IASB, the best in terms of the world, of making brilliant standards. And the Financial Services Authority is like what you have for SEBI. For private companies which are not listed, say we don't have any power on it, we have Ministry of Corporate Affairs. Okay, so that's how the combination of regulatory and technical body come together, and these are the rules which sometimes bore or bother a non-commerce student, but they are very logical. And in my course, with you, we are going to handle them relatively in a commonsensical approach. And almost on my fag end of this small video, this you have already done, so I can really quickly wrap this up. Financial reporting is actually telling the world what you have reported. So do you see that from stage 2 we have shifted to stage 3? Now you are not recording the transaction as business, you are now reporting and telling the world. And financial statements are nothing but medical reports. How many medical reports are there? Broadly 3. There is the fourth one, which is the new kid on the block. We will talk about it later when we talk about balance sheet in detail. Okay, you are aware of the fact that each medical report is a separate format communicating a very specialized aspect of business. X-ray, MRI and CT scan. These are 3 individual reports. Similarly, balance sheet, P&L, cash flow, three different individual reports, right? And I'm going to end this video by quickly giving you these 7 things. There's something called as annual report, and I would strongly urge all the non-commerce students who are looking at it to please download any annual report of your choice. Listed companies are better because they are more descriptive, colorful, imageful, graphical, and easier to read. But an annual report, as you can imagine, is a report which comes annually. Wow, what a wonderful revelation. Well, what does it contain? You would imagine that every company will tell the world about the financial report. So point number 6 is no brainer. But in addition to point number 5, my apologies. Point number 5 is a no brainer. But in addition to point number 5, there are some other very, 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 very important things. Look at here. Okay, look at here. First is I want your attention to 1, 2, and 3. These are all narratives, words which describe the why. What does financial statement describe? What? What happened? Profit went up. Okay, the numbers will tell you 12% growth, but narratives will tell you why did they go up. So it's extremely critical for any business student to not only focus on the fifth element of financial statement directly, but go through 1, 2, and 3. You would see 1, 2, and 3 largely will have the same tone. I'm using the word tone. It could be a positive tone, negative tone, anxious tone, confident tone. You would be able to gauge it. And after reading 4, 5 annual reports, you'll get a sense that financial statement are telling that profits are down by 10%, but this tone is very, very positive. Is this company coming out with follow-on public offer and wanting to build their image? Things like those. So this is a point where sometimes we say that you should take things with a pinch of salt. Sometimes the company think that we'll buy a dollar bill for 97 seconds. We will not be able to. So and that's where the manipulative intent and window dressing, etc., come into picture. But let's not bring those in right now. So 1, 2, 3 is completely narrative, written by the management, which is nothing but your CEO and the board of directors, where they're telling the world about what they think the situation of the business is and why it is. So it is from the horse's mouth. This auditor, we are going to talk about in the live class, is a statutory auditor, an independent person to the company who is only responsible for, so to speak, a surveillance. It's like, you understand audit, it's checking, independent review. Dikhao, whatever you've done, is it right or not? It's that kind of an attitude. So there is a report related to auditor as well, as per his assessment, are financial statement truthful or not? Then point number 5 is, of course, the meat of the annual report, the results. Sometimes they're also called at results. What are the annual results? Gain, loss, total assets, total liability, equity, things like those. Very, very, very important are point number 6 and 7. They are very critical, but the two are still different. Allow me to explain. While schedule is basically a supplementary information, which even if not available, you can't complain to a regulatory agency. This is all very, very voluntary. Most of the schedule, if the company wants, they can hide away. Okay, but notes to account is something which is different than schedule. Notes to accounts is basically a wordful, or should I say wordy, summary of related to financial statement, not about the narrative in terms of why did the profit go up and down. It's basically to tell the reader about the assumptions, estimates, and the choice of accounting policy taken by the accountant in order to give out these financial statements. So imagine I'm just kind of jumping the gun by telling you that inventory could be valued as per weighted average and FIFO. You don't have to worry about what are these right now, but just understand that these are two different methods. Now, as a reader of a statement, I need to know that these results that I am reading is as per first in, first out, or are they as per weighted average? Where will I get this? Because financial statement is a one-pager document. You would have made it yourself. It's a number game. It has list and a number written. There is no place for descriptive. So these are actually the descriptives to the financial statement. Therefore, it's super critical to read them in tandem with financial statement. Okay, so any good analyst, one of you and all of you will become wonderful analysts. But the difference is between an average analyst and a good analyst. An average analyst will start focusing on financial statement, whereas a good analyst will always focus on the narratives more. All right. So I understand that, like, every time I have taken a bit of an extra time. So thank you very much for your patient listening. I am really excited to meet you in the live class where we're going to just wrap these things up and close the first module more or less, where we're trying to bring up the non-commerce students up to pace with the commerce ones. All right. Thank you very much, people. I'll looking forward to speak to you in the live class.